You are live now.
A very good evening to all of you. Uh, I, on behalf of the Executive Committee of FBS, welcome you all in this webinar, which is basically related to your personal finances and security for future. With me is the chairman of FBS, Dr. Quresh Maskati, who has held various positions, which includes the presidentship of All India Ophthalmological Society. We have with me my co-moderator, Dr. Poonam Jain, who also is a very renowned oculoplastic surgeon, but is also very well versed with the economics, with the finances and other things. So she will be a very, a big help for me as far as moderating the session is concerned. We have three speakers with us. We have with us Dr. Akash Patel, who is expert in financial matters related to most of the things, and he'll be discussing some pertinent topic today. We have with us Dr. Harikrishnan Vanadil, who again is currently at Hyderabad and has been trained at AFMC and is a very renowned ophthalmic surgeon, but is well versed and very knowledgeable in the field of finances, health insurance, etc. We have with us Dr. Sharad Babu, who is the Honorary General Secretary of Family Benefit Scheme. And apart from that, he is Chief Medical Director, Max Division Eye Hospital, and also Rotary Governor. And he will tell us about about FBS and why we should join. We have with us a stalwart who has always guided us in FBS, a very tall personality, Dr. Ranjit Maniar, who is past treasurer, Family Benefit Scheme, but he's like a mentor and he keeps guiding us in day-to-day activities of FBS. We have with us Dr. Rajiv Mukherjee, who is the Vice Chairman of FBS AIOS, and he is the Director and Senior Consultant at Mukherjee Eye Clinic at Delhi. We also will be joined shortly by Dr. Stanshu Mathur, who is the Treasurer of FBS AIOS and Director High Tech Eye Hospital Sitapur. Kashipur. We also have with us Dr. Indra Mohan Rastogi, who is the Joint Secretary of FBS AIOS, and Dr. Kedar Nemiwant will be joining shortly, who is the Joint Treasurer of Family Benefit Scheme. So, without much ado, we should start the session. And before we actually invite the speakers, I will request the chairman, Dr. Quresh Maskati, to say a few words.
Thank you, Rajesh, and I welcome all of you who are here. So this is in Mumbai. We have favorite dish which we call the bhel puri, and today we've got lovely bhel puri of experts to deal with various aspects of financial matters, right from simple things which are not so simple, like fixed deposits in banks, to health insurance, and of course, leading up to the family benefit scheme and how it benefits all and how all should join. So, one thing I can promise you, stick with us for the next 1 hour. You will not get bored, and it will be a learning experience all around for everyone, young and old. This will be a learning experience. I am waiting to hear from the experts also. So, Rajesh, I will defer further comments to the end, and let's get the ball rolling. Thank you.
Thank you, sir. So we have with us Dr. Poonam Jain, who is herself an expert in finances, of course, a very renowned oculoplastic surgeon, but she's an expert in finances. And from here, I'll hand over to her to moderate the session and take it forward. Dr. Poonam Jain, please.
Thank you, Dr. Rajesh, for your kind words and nice introduction. I'm not really an expert, but we are all learning, and this is a very important part in our life We have been practicing ophthalmology, but we must know how to safeguard our money and learn more about personal finances. So I would invite Dr. Akash, who is an expert actually, to share his views. Now, to share his insights into the bank FD. We all are invested in bank FD, and we know that it is a popular investment choice because it offers the safety and guaranteed returns, and it's a traditional investment option that our parents and forefathers and all have been invested into. But let's look into the finer details. So, Dr. Akash, uh, let me share the screen and let me ask you to start your presentation, and let's hear about the. I hope my screen is now visible.
Yeah, yeah.
And
Just make it full screen.
yeah, I have made it the full screen. And this is our first slide. And standard statutory. Okay. So, Dr. Akash, please take over
Yeah,
and introduce the topic and go ahead. I'll be asking a few questions to basically keep us all on track.
yeah.
Over to
So
you,
good evening.
Akash. Yeah.
Yeah. First of all, I would like to thank FBS AIOS team. That's a wonderful job that you are doing, and wonderful opportunity to share my views on something as simple as Bank FD, because this is something which touches everybody of us. Majority of us are not into equity markets. Some of us are, but then Bank FD is something which we cannot do without. And when it comes to Bank FD, let us understand that every money is hardened. So in stock markets, maybe you are investing, say, 1 lakh rupees and it might become 1 crore. But then, per se, you're not putting your own hard work into it. You might be taking risk. But when it comes to Bank FD, every single rupee, especially that of a doctor, is hardened, because then, you save and then you invest into Bank FDs. And then when something goes wrong, we tend to lose everything that we have, especially for those who are solely invested into something like a Bank FD and gold and maybe something like a small real estate piece. So Bank FD, for those who are not an equity person, they form a majority of the investment plan. So let us take few cases which have happened in last few years. So there was an issue with one of the well-known banks, that was PMC Bank, and then people lost not only their money, they lost their lives also. So kind of it becomes really tricky in that sense. Next slide, please. And then we have had a case of ILFS in 2018, and even the FDs done with the same thing. These are all NBFCs, and then even sometimes people are lured to put money in NBFCs. This was one of the largest financial institution in the country, and people have lost money with something which was a term deposit or a Bank FD. Sahara scam is well known to all of us, probably majority of the people in the north and northeast, especially in the West Bengal and other places. So we have kind of data which says that more than 50,000 people have lost their hard-earned money to bank frauds every year. So this happens year on year. RBI has itself cancelled. RBI is kind of a father figure to all the banks, and then it itself has cancelled bank licenses of more than 58 banks since 2020. So when majority of us started actually investing and taking investment as serious things post COVID, more than 100 banks have closed down, and more than 700 plus rise in the digital frauds since 2022. These are all published literature, of which I have quoted. Investors have lost more than 3 lakh crores to Bank FD frauds. So please understand, majority of us are worried about, say, equity markets, and we are really skeptical before putting money into equity markets. But the people lose money in the Bank FD also. So we are going to discuss how to save our hard-earned money on, say, the topics which are kind of, where all can you do your Bank FD, and then which scheme should you be going for maximum interest that you avail, because the interest is not going to differ for, say, Dr. Rajesh Sinha or Dr. Poonam Jain or for myself. Then how do you maximize your interest on the available interest which is offered by the government or by the bank? Whether to go for a quarterly multiplication tenure or something which is an odd figure which the bank has to offer, something which might cause you to do premature FD withdrawal, whether you should be opting for it or not. And what is an FD OD? Majority of us don't know what an OD is, or probably have never availed it. So that might save much money on that. And what are the risks involved? Since it is an investment, and with every investment, it comes with a risk. So what are the risks involved in the bank FDs? Finally, we are also going to discuss how to pass on the bank FDs to our next generation, and what can be done to kind of save the trouble in case of a mishap. So
We know that bank FD does not really get us wealth, but then still we need to know about the bank FD. Why?
Basically, Bank FD, as is shown in the pyramid, the Bank FD forms the lowermost part of the pyramid. That is along with the gold, one needs to have a residence of his own, life insurance, PPF, NSC, government bonds, postal scheme, and the Bank FD is as part of it. Only when this base of pyramid is kind of formed, then it is then you move on to the equity mutual funds or even direct equity investing. Because when you need the money in times of need, the odds are high that the stock market might crash, say, or it could be your individual stock might be say 20% down, and you cannot remove money, say in case of something, god forbid, something like a heart attack or a fracture. Then when you want an easy money, Bank FD is your only option. So it is mainly for the liquidity purpose, and it forms for the base of the pyramid for people who are kind of starting out into the taking investment seriously.
So what should be the ideal proportion of our portfolio that should be invested in the bank FD?
A majority of the doctors usually keep it around 50% or even say 30% of their kind of portfolio. Sometimes it's almost 100% into bank FDs, which is probably might not be a really nice idea. What is typically suggested, I mean, by the textbooks, is to have at least 7% allocation, not more. It could be slightly here or there, so 7 ka 10% ho jaye, that might not be a real big deal. But say more than 7% allocation might not help you build wealth over a period of time. So of course this will differ for every one of us, but say to begin with, 7% is a good idea to kind of look forward to.
Because it is a safe option offering guaranteed returns. So what exactly is the objective of doing a bank FD? Because it does not let us create wealth.
Yes, bank FD doesn't help create wealth per se. So, like say, suppose if your bank FD, especially when the interest rate right now they are on decrease, and when they were lows, at their lows during the COVID times, it was offering 5.5% interest. So after one third goes into income tax, it comes to 3.5%. 7% is the perceptible inflation, no matter what the newspaper tells us. Your this 3.5% becomes minus 3.5%, and when you add a rupee depreciation, which is around say 10 to 15% year on year, net value of that 1 lakh rupee which you did bank FD, the next year it comes to say in the minus, say the value of that is 95,000 or 90,000 or something similar. So basically, bank FD is not for wealth. Majority of the doctors have that notion, and all said and done, if I can send you off with one take-home message that bank FD doesn't help build wealth, but it is needed as a part of your overall portfolio, given that the liquidity which it offers is really great. Now, majority of us think that bank FD doesn't offer liquidity, and we think it as a sacrosanct investment not to be touched unless something grave happens to us. But let us kind of explore further how do we change that view. So the advantages of the bank FDs are obvious: a decent returns at low risk. That is, you don't take any risk, and what you get on return on paper is what you get at the end of the year. A higher rate is for the senior citizens, especially those who don't want to take risk of stock markets, because then you cannot be into stock market for another 10, 20 years. Then probably you want to have a safer investment option and regular income. Probably bank FDs want to go. You can do it with very low minimum deposit limit. Probably you don't need, I mean, even say when it comes to advising our staff and other people, that they can do it with a low minimum deposit. The resident doctors also can do it, especially when the savings are low at their end. A higher stability of investment, because you don't want to rock your boat, especially when you are starting out or venturing out for the first time in investment world. And you have a choice between regular payouts or lump sum at maturity. This is really helpful, especially if you are dependent on that income when you are a senior citizens.
And there are many options.
Options, yes, kind of, theoretically, majority of us know that, because this is something, and this is investment style which we inherit from our parents. And the difference between our parents is at that time, the bank interest rates and PF interest rate used to be in order of say 12% or even higher. But now, then, since the interest rates are really low, majority of us, because like I told, we inherit it from our parents, we know that bank is the only way to go when it comes to bank FD or term deposit. The correct term for it is term deposit. But then term deposits can also be done with, previous slide, please, with the NBFCs, that is non-banking financial corporations, something like a gold finance company, or say various other NBFC, ILFS, and various other institutions that we talked about, the housing finance companies, the small finance banks, and you can also do it with, say, corporate. So something like a Larsen and Toubro or Reliance, they would also have something like a corporate FD that is particularly are usually meant for their own people, their own employees, but sometimes it is open to others as well. So this, you should know that there are other options available apart from banks where you can actually go and do your deposits. The majority of the common banks, both private and the nationalized, are mentioned over here. These are typical rates. They keep on fluctuating from, say, quarter to quarter, depending upon where uh, the RBI and the Monetary Policy Committee, MPC as it is called, changes the interest rates or tweaks it. They keep on changing, but kind of, you have various potpourri of banks where you can actually do the bank FD, and the interest rate will differ at any kind of particular point in time. They will differ from bank to bank.
But there are a few checklists when you start a bank FD. What should you basically be looking at?
Absolutely. So kind of, people kind of, are really, well, let us say that we are talking about common people, not especially when it comes to doctors, but say, like I told, bank FD is something which is pertinent to even our understaff. So, sometimes they ask where should I be doing FD, and this is would help us around. So risk reward ratio, how much of the interest you are actually getting when you are putting it into bank FD. So something who's an ace investor into stock markets, if he's getting nothing, then probably he might be better off putting it into stock markets than in kind of this thing, because there's something like a COVID, you had nothing to lose, and then everything by doing bank FD. Sometimes the interest rates are so high that it makes sense putting money into the bank FD. And when it comes to assessing the individual banks, you need to know their asset quality, capital adequacy, what is called as Camel's model. So it becomes a bit lengthy to discuss in a short duration, but per se, you want to go with a reputed bank and not any Tom, Dick, and Harry bank, or say something who's offering high interest rates. So somebody might be offering you 10% when a reputed bank might be giving you, say, 6% or 7%. But that extra 3% can entail that you lose the entire 1 lakh rupees for 3,000 rupees. So that risk reward ratio needs to be kept in mind even while you are doing the bank FD. The compounding frequency which the bank has to offer, because that again will differ from bank to bank. Somebody do it for 12 months, somebody do it for 13 months, and then the calculations thereof. The withdrawal term, should you need money in the middle of the kind of tenure, what happens to that you should be inquiring, and that you should be inquiring every time, because then these banks, they keep on changing every few months. And the service quality of the bank, so you are resting your hard said money with the bank, and bank is something which people want actually you to put or do in their bank. So you should, if you are putting, say, several lakhs worth of bank FD, especially if you are a doctor, you would want a better service than otherwise. So that is how it goes. The credit rating of the bank is something which is as simple a thing. You can even Google it, and you should be doing it. There are various credit rating agencies. You might want to take an opinion of 2 or 3 credit rating agencies. That is an online thing, hardly a click of a button, and then you are good to go.
And there are different types of FDs.
Absolutely. So a majority of us, kind of, like I told, when we inherit from our parents, we traditionally tend to do whatever they have done. We do it on ad hoc basis. But we need to understand that few of the private banks, especially, they offer bank FDs with insurance. So something like, if I have a bank FD worth 30 lakhs in a given bank, not all is insured by the government. So say, suppose, God forbid, something happens to my bank and I lose, say, 30 lakhs. I have a 30 lakh bank FD in one bank. I lose it in toto. The only my 5 lakhs maximum is secured in a given bank by the government. So this is something which is kind of rule of thumb. The government is planning to increase it to, say, 10 lakh rupees, but it has not done it as of yet. Our honorable Prime Minister has mentioned it, but it is probably, it will take some time. But then there are bank FDs which are there with insurance. So you might have to pay say 100, 200 or 250 rupees more, especially in the private banks, and you can actually insure your bank FD. So should something happen to your I mean, or to the bank or any other major credit risk in the within the system, your bank FD is at least secured. You might have to let loose of say 250 rupees, but then your interest and everything is secured. Your main capital doesn't you know go haywire.
From what I understand, it is 5 lakh is secured in one given bank
In one
per
given
person.
bank, in per
Per person.
person.
So
Yes,
if a
yes,
person wants to suppose invest 10 lakh, 15 lakh, should he be
yes,
opening 5 lakh, 5 lakh, 5 lakh in different
yes,
banks?
yes. That is the most advantageous and most advisable thing to be done. So if you have say 15 lakh worth of deposit, you can. Then there are no cap to how many bank accounts you can open. So there could be a different interest rate of difference of 0.5% or say 1% between say two or three different banks, but at least your entire money is secure. Like I told you, do this for your security, and when you need money in the middle of the night, bank FD is the only thing which is going to come in your handy. Because then pledging gold is even a bigger psychological trauma, especially when you are already traumatized from the physical or the psychological perspective. So
Yeah.
that is where bank FD would come in handy, and you want it to be a safe investment. So divide it between two or three banks, and then you're good to go. Then there are something which are non-tax saving, which majority of us do. But then there are something which need to know that there are tax saving FDs, which are usually for the longer tenure period. Usually minimum 5 year period is
5 years.
what they do for the tax saving bank FDs, and they are a good option, especially if you're into higher taxable bracket. Non-auto renewal, wherein they will be asking you for every year, but then issue with the doctors is that you are not available on stipulated time and month every year, and especially if you are not going to need that money for say a few years together, it is better to opt for a 1 year tenure, so that every year you can judge how much your money requirement is going to be there for every year, and then kind of
But then
on
the
in
risk
auto
is
review
that
mode.
sometimes the risk of that is that sometimes the rates come down. Like now the FDs are
Yes.
very low rates.
Yes.
So
So that is why every year you can do it, especially when the interest rates are not fluctuating. If they're fluctuating really well, or if you are doing it or at all-time high interest rates, then probably you would want to manage that interest, what is called as interest rate risk, and then you want to opt for a longer period of time. So that is what usually is done.
so how
Previous
does one
slide, please.
maximize the interest on FD?
Yeah, previous slide, please. Yes, so monthly, quarterly, and yearly. These are the three interest options which majority of us don't know, especially for people who are already doing bank FDs and want to transit to mutual funds or say, I mean, talking about equity mutual funds or stock market. They can actually opt for taking quarterly interest and slowly put in money into the stock market, so that you are not liquidating. Say if you have 10 lakh worth of bank FDs, every quarterly, if you are getting say 5,000 or 10,000 interest, you can actually slowly slipping it into say stock markets and do it. That the option, the advantage of that is you are not putting big money in a lump sum manner, and you are getting a good advantage of what is called as a systematic transfer plan. So you can slowly systematically transfer the money which you are getting, the interest, only the interest, and that way your money is safe, the bank FD money is safe, and you can this thing. Those who are in dire need of money, the our understaffed, they can opt for a monthly interest available scheme.
But then you want to maximize your interest, na? So it has to
Yes.
become a compound
Yes,
interest.
absolutely. So compound interest is what we should be aiming for. So this is there are two graphs. One is almost a straight line, which, like I told, in theoretical theory it is a straight line, but then actually because of the rupee depreciation and other factors, the taxation and thing, the graph actually comes down. What we want is a hockey stick type of effect. Of course, that happens practically. Such type of effect happens only in say with equity markets, but when it comes to bank FD, we want to ensure that this graph is levitated to the maximum. And then there are various ways to go about those things, and which next slide, please. So you have something like a normal bank FD, a reinvest FD, and a recurrent FD. So please understand, majority of us are opting only for a normal type of bank FD. Even those who don't need money, they are opting for a normal type of bank FD. What you would want is something which is a reinvest plan. Yeah, next slide, please. the difference between a normal FD is kind of, what you get is a simple interest as printed on receipt. कि भाई आपने 1 लाख रुपए रखे और उसमें 7.2% आपको इंटरेस्ट लिख के दिया है, that is what you will be getting at the end of the say 365 days. But in the reinvest plan, what you get is a compound interest on maturity, and that is what you would want to, especially when you don't require the money for the whole year. So if you're not going to put it into stock markets, if you are not, if you are something as a senior citizen and you want to, compound it only with the help of Bank FD, reinvest plan is something which you should be opting for. And then there is something for somebody who's, already short of money, but yet want to make a Bank FD, what we call it as a recurrent deposit. Next slide, please. So recurrent deposit also gives us a compound interest on maturity, but it is an additional liquidity advantage. कि मेरे पास मान लीजिए 10 लाख रुपए है, but 10 लाख रुपए मुझे बीच में कभी भी जरूरत पड़ सकती है उसकी. What I will do is I'll just keep on doing say 1 lakh bank FD and kind of putting it to 10 lakh rupees total at the end of the year. For somebody who's having even with say smaller, say they are having only 10,000 rupees, somebody who's a resident, somebody who's really short of money, they are kind of earning from the especially beginner practitioners who are earning from the hospital and putting it to the bank FD, they can open a recurring deposit account, and you can kind of actually get an interest. But the difference, of course, there will be a difference between what you get in say at say compounded quarterly, something which is compounded quarterly, 12,000. This we have given a kind of bifurcation.
So recurring
12,000
deposit has
rupees.
a lower return. It
Yes,
has
a
a
recurrent
lower return.
deposit has a lower return, although it is compounded, because then you're so you are putting in 1,000 rupees every month, but then
Yeah.
kind of what you are getting is your median say 12,000 is not happening right from the day one. It is happening at the end
Yes.
of the tenure. So that is why you get a lower interest on say what even though the interest rate is same 9% over here, what we have
Yeah.
considered, but then the actual difference changes. And then there are other kind of small variations. Probably, like I told, recurring deposit won't be mattering to majority of us, but for our understaff especially, we want to advise them at least to start with recurring deposit and save money, if not anything else.
This is an important thing to know because FD basically we are doing to have liquidity. But once we have put it in fixed deposit, we feel that it is fixed and it is non-callable. But then if you need money in emergency, how do you make it liquid?
Yes, so I would like to kind of call fixed deposits as a misnomer, in the sense that it is like playing our game with our brain. The thing is that it is the correct word is term deposit, and whenever we liquidate it before the tenure, there are kind of certain penalties which are kind of levied on to us, because the bank FD bank what happens is why these penalties or 1% penalty interest is levied on us is also important to understand, because the bank will be giving it to somebody else. So if say Dr. Akash has done say 1 lakh rupees bank FD, that 1 lakh will be transferring to say Dr. X, Dr. Y, or Dr. Z for his hospital purpose or whatever he needs money for. And the in between is interest difference is what the bank earns, and kind of that is what that is how its business run. But whenever we take it, then that entire thing gets skewed, and that is why it levies the 1% interest. Now how to kind of avoid it? Now majority of us are not knowing this. There is a facility which is known as Bank FD overdraft facility, wherein if you already have a Bank FD, and kind of what you need to do is say if you are getting 7% interest, you need to pay 8% interest to the bank. That is net only 1% difference is what you need to pay to the bank, and you can actually kind of avail. So not entire capital. So if you have 10 lakh worth of bank FD, 9% will be 90% will be usually the limit. So they'll give you 9 lakh rupees out of the 10 lakh rupees in the middle of the night if you need that money. You just need to kind of it's sort of a pledging of sort. So you have to give your bank FD to your own bank, and they will be giving you 9 lakh rupees on 10 lakh rupees which you have. The interest that is going to be calculated, that is going to be calculated on a day-to-day basis. So say today you have sanctioned it, but say you need money after say 1 lakh rupees after say 3 or 4 days, say 2 lakhs after say 5 days, 10 say 7 lakh rupees after say 3 weeks, then probably on day to day basis whatever money that you have used only on that money or for that stipulated period of time you will have to pay the interest, and this will be done in a separate account. So there is something called as FOD account which will be opened up especially for you, and that money will be availed from that, and you have to kind of, whenever you return the money, that interest calculation will, that meter will stop at that particular thing.
So
This is
what
usually
is meant
helpful.
is that if somebody needs money in between before the
Yes,
tenure is over, don't
yes,
have a premature withdrawal, because then you have to pay the penalty.
yes,
Ask for an overdraft or a loan, because
yes,
FD can be used as a collateral and you can
yes.
take a loan against it. So
Yes,
that
but then
makes
the
much
issue with
more.
the loan is, now the difference between the overdraft and loan. Overdraft is usually preferred vis-a-vis loan, because loan is, say today you got sanctioned, and like I told, if you have say 1 lakh which you need right now, 2 lakhs after maybe a week, 3 lakhs after say 3 weeks, then kind of, in overdraft you pay only for the days and the money which you have used. In loan
Yes.
you have to pay, that meter starts right from the moment they have sanctioned the loan, so that becomes a bit tricky in the sense. So unless required, don't take a loan, prefer overdraft. Both will mean one and the same thing only, but over here you will have a better kind of,
Better to take the overdraft.
better to take a
Yes.
overdraft in this, especially when the tenure is ultra short. So
Hmm.
that is real, this thing.
And we would like to know about the risk. We have already said that there is a risk of the bank, the risk of the division between family members, and because we are running a little short of time, so we'll
Yes,
go to the other point, which is very important.
yes,
If you have to suppose put 5 lakh in the FD,
yes.
then should you be putting 5 lakh or should you be laddering it, please?
Laddering is something which we have to do, which is preferred in the sense that, because the key objective of bank FD, like I said, is liquidity. So if you have 5 lakh rupees, maybe you can opt for 50,000 every month, and then kind of, that is how you do it. You do one in January, one FD in kind of this thing, instead of putting entire 5 lakh in January itself. If you do it every month, then probably, you will be never short of money, especially when you need it. So you don't know what your requirement is going to be in March of say 2026, and then kind of, or July of 2027, and then if you are laddering it that way, it works well. It basically prevent losses from premature withdrawal, and the liquidity and the consistent returns which the bank FD has to offer.
Now, the longer tenure FD, if it is more than 5 years, it also gives us ATC benefit,
Yes, yes, and
1.5 lakh.
yes, and especially if you are doing it at the highest interest rate, your kind of, 8.5% is locked in. Especially if you're not going to put it into equity markets, then it is a good way to lock your bank FD for the longer term.
Now, this is another important point, the estate management. In case something happens to the person who has done the FD, then what happens and how
Yes.
to.
So you need to understand, this is very important. Nomination has to be done for each FD individually. So if I have 10 FDs in one bank, you have to do it for each individual nominee. So I might give say 5 lakh to my mother, 5 lakh to my daughter, my 5 lakh to my kind of, every family member, and that can also be done. The nominee, after once that, will have to do lot many procedural things, that is obtaining a death certificate, and then kind of, obtaining an inheritance or a Varsai certificate, as well as kind of, doing of something what is called as franking. But then, in period of such distress, it becomes bit tricky to do all these things, the KYC and the form 60 Aadhaar card photo and all this thing, and this will be have to be done per bank and not per FD. So better solution for this is, especially while you are alive, is to do FD in two names. The advantage of that is kind of, you have Dr. Akash, and then you have say somebody who's not yet, but then Mrs. Dr. Akash. Then probably, what you can do is, uh, kind of, in case of discrepancy, the will rule. So over here, when you do FD in two names, the income tax liability will be of the first holder. The second holder will only be kind of, will get hold of the bank FD after the first person dies. So this you need to remember. Next slide, please. Yeah, so if there are four
And
members, you can do it say FD1 in A, B, C, C, D, and D, A. So that way, all the four members are, part of the bank FD. For any other further queries, kind of,
So
My number is there. Please note it down. You can. I'll
another
be
very
happy to answer.
important thing I would like to add is that it inculcates a financial discipline. And
Yes.
doing an FD is helpful for people who have a strong urge and impulse to spend the money.
Yes.
So one should at least start saving some money in the beginning of their career itself to
If you want
inculcate
to
a financial discipline.
if you want to
So
be a good equity investor, I won't go to an extent to say if you want to be a good equity investor, you need to be a good FD management person as well, because every 0.5% counts. Every 0.25%, if you're not mindful of that, then you are not never going to make money in equity market. So that you need to understand.
Thank you. Thank you, Dr. Akash. Very nice presentation and, of course, very nicely moderated by Dr. Poonam. I have just one query on this. Now, do we really need to do an FD, or if given a choice, what should be done? Debt, shall you put it in debt fund, or you should do FD? Because FD, as you said, that finally it's not going to increase your wealth. And most of the people do FDs, only the middle class people do FDs. Okay, just to have a sense of security that their money will, further increase.
Yes.
But it is not increasing actually. You are getting 6% and giving 3% tax, and then of course depreciation of money is also there. So, do you think debt fund is a better option than FD?
But sir, then, like I told, the sole objective
Because
of
liquidity is
me
also
doing
more
Bank
important.
FD is liquidity. So if you can avail loans or say overdraft on say a debt fund, then probably debt fund is kind of better option. But unless and until that is happening, probably I always do opt for a Bank FD, at least on my part. I never put it in debt fund. The very reason is the liquidity advantage.
Akash,
Like stock.
liquidity and
what is
safety.
the financial the penalty for premature withdrawal?
So 1% is what they charge of
So
the.
if
So if
if
you've
your
done one
FD
lakh
was
Bank
giving you
FD,
6%, it will give you 5% if you withdraw the
no, no,
amount.
sir, 1 lakh. If you're given them 1 lakh rupees, they'll take 1,000 off, and then they'll hand you over 99,000.
No, but what about the interest that has accrued up to then?
Up to them, sir. Sir, if you are opting for the quarterly interest, then they'll be giving it to you.
Okay.
Quarterly
No, no.
interest
What
hai.
I'm saying,
So like I've done is
suppose
yes,
I've done a simple FD for 1 year, and
yes,
after 6 months I need 1 lakh, and I need that money after 6 months. So
yes.
will they give me interest for 6 months and cut some amount, or will they just
Yeah, they'll be cutting it, sir. They'll be cutting the interest which they have kind of if you are doing it, of course they won't be giving you the interest in the first place itself. If you're opted for yearly tenure,
yes,
so if you're doing in January and till say December, and then you want the interest rate only in December, that is 1 year tenure and 1 year interest payout. And
correct.
if you're cutting it in June or July,
Yeah.
then probably kind of you won't be getting the interest, and they'll be cutting 1% of whatever your this thing is. Because then, like I
Okay.
told, they have that entire
Chart. Yeah.
thing goes no, they have the entire thing which goes haywire. Na? They have given to somebody else the money,
Yeah. Yeah. Yeah.
and then they'll have to borrow from somebody else and then give it to
Okay.
you.
Okay. Thanks.
That's also one reason why I was wondering that liquidity also is better with debt fund than with FD.
But sir, once you are doing laddering, then liquidity is also always there with you. Na? Probably not in the initial year, first year, but then every month you are one of the FD is maturing, so that way you have the liquidity. And like I told, at any point in time you can avail overdraft. Na? Suppose God forbid if anybody has a major accident, he needs a 10 lakh rupees right away. He can always take 10 lakh rupees for say maybe 15 days or 20 days and then put it back whenever.
So Dr. Akash rather,
Yes,
what
sir.
we're looking at here is safety. We're
Yes,
looking at liquidity.
absolutely.
We're looking at an insured amount, and we are working on the compounding of the interest.
Yes.
These are the four things majorly that we look at. And with that, you manipulate your tenure, your bank, etc., to make sure that you get the maximum returns on your investments. But safety and liquidity are the two prime considerations. Am I right?
Yes, yes, sir, absolutely. One mistake which everybody does is probably if they have 30 lakhs, they'll do 30 lakh Bank FD in a go. Please don't do that. Either ladder it or say do, even if you want to do it on a single day, 10 lakh Bank FD. If you have say 30 lakh rupees, you want to do 10 lakh FD, just do 1 lakh 10 matlab FD of 1
10,
lakh
10,
each
10.
or for say 10. lakhs. So that way it is works better than you putting in one FD, single FD of 10 lakhs. So that way, kind of, please
And
avoid
one
those
important
mistakes.
thing, which the 1 lakh FD, 10 FD, should we do in the same bank or different bank? As you told,
Yes, preferably different bank, but say even if you are doing it on a date, even in a given bank, also it would be preferable. So let us presume that 5 lakh is, like I told, is the sum insured for a given bank. Please don't do 5 lakh in toto or into a single FD. Just do 1 lakh 5 FDs. That way, what will happen is even if you have to break it, you require only 2 lakh rupees for say your accidental say tooth fracture or say bone fracture. Then you just need to break say 2 lakh worth of bank FDs and not the entire. Otherwise, if you're just doing one single FD of 5 lakh rupees, you have to break it as a whole if you need money and you don't want to take an FDOD.
Okay.
Thank
Any
you.
other?
Thank you a lot, Dr. Kash.
Yeah.
I learned a lot today. Thank you.
Thank you, sir.
So thanks a lot, and let's move on with our next talk. So we have Dr. Hari Krishnan, who will be talking about uh, the health insurance. And the basic idea of knowing about health insurance is there are two perspectives. One is, of course, the perspective of a doctor, like we want to know what exactly is the health insurance of the patient, what all things should be written, so that I don't know how much is of the policy, etc. And the as a patient also, we should want to know that what exactly should be there in the policy. So, Dr. Hari Krishnan, please. Thank you.
So thank you for the opportunity, sir. So I normally deal with health insurance from the provider side, that's the hospital side, where I guide hospitals on billing and part of the insurance committee in AIOS and also. See, there are a lot of factors in a health insurance policy that what I'll go through 10 factors and I'll try to explain it from both perspectives. Okay. So first of all, why do you need health insurance? Is because most of the families in India is just a medical bill away from poverty. So in a family, you get one person with some onco case or some cardiac issues, stays in the hospital for quite some time. That's going to drain the money out. So that is a financial security and it's a peace of mind for the family. That's the basic requirement of health insurance. Now, when you look at health insurance, one of the biggest factors that everybody talks about is the sum assured and coverage type. So, what is sum assured? Sum assured is the amount that the insurance company is committing to that they will spend on you in case of need. Okay, so it can be individual or it can be floaters. So, when you say individual, if a family of 4 people, if each individual is covered by 2 lakh, 2 lakh, 2 lakh, 2 lakh, it's an individual coverage. Whereas if everybody together is covered by 8 lakhs, then it's a family floater. Now, the benefit of family floater being that any of the individual can go up to 8 lakhs in expense in terms of medical. Now, the problem, one of the biggest issues that, we as doctors, as we have bought our health insurance. A lot of people have bought their health insurance many years back. Maybe that time the expenses were lesser. The expectation of a medical bill was lesser. So I see a lot of people with 3 lakhs and 5 lakhs insurance policies. Now the problem is that in today's world, 3 lakhs, 5 lakhs insurance policy does not touch anywhere. Like you go to a decent, good enough luxury, premium hospital and get a treatment done, and it's going to cost you more than that. Now, the interesting part is that we look at the premiums and say that, okay, this much is the only thing we require. So the underinsurance is the biggest issue, one of the big issues that we face. So we tend to buy smaller amount, expecting that we will not need it, but when we need it, we end up paying out of pocket expenses. Now, how do you counter that is by something called as a top-up policy. So every individual, in my opinion, requires two policies. One is the base health insurance policy and a super top-up policy. Now, base health insurance policy may be of 5 lakhs, 10 lakhs, 20 lakhs. Some people have 25 lakhs, depending on how much of coverage you're looking at and what is the scale of healthcare that you're looking at. So apart from that, any expense going beyond that can be covered by the super top-up. Why super top-up is because when you buy a super top-up policy, the premium is going to be very less. Okay, for up to around 40 lakhs, 50 lakhs, you will pay premium in 3 figures. But the thing is, super top-up will kick in only once you exhaust the sum assured in the base policy. So my suggestion here is to have a base policy which may be even lesser, but have a super top up add on to that so that your total coverage is good enough, maybe 40, 50 lakhs. So you will get it at a very lower premium. Now, from a hospital point of view, in ophthalmology setup, the importance of sum assured is very much limited because there are very limited conditions in ophthalmology where we would even touch 50% of sum assured in the insurance policy. So here I'll skip the provider part. Okay. Now coming to the pre-existing disease waiting period. Now understand that. Imagine that somebody has needs to undergo a surgery. For example, cataract surgery, or need to undergo a vitrectomy for diabetic retinopathy. Now the patient is told by the doctor that you need a surgery. Now, what is the patient going to do? He's going to go to the market, buy a health insurance policy without declaring his condition that he's going to need a surgery. And immediately after that, if he feels a claim, it's going to be a huge loss for the insurance industry. Understand that insurance industry is also a business house. They need to run their business and they need to be profitable there. So what they do is that they put some clauses which says that few conditions will be covered only after certain duration of the policy is completed. This is called as pre-existing disease. Pre-existing disease in the sense hypertension, for example. If a person has hypertension while buying the policy, he will not be covered for effects of hypertension. That is maybe a CVA, maybe hypertensive retinopathy, maybe BRVO, CRVO, or maybe any cardiac conditions will not be covered till the time he covers the waiting period. Now, shorter the waiting period, higher the premium. Okay, so if you think you are healthy, you are not going to be requiring any PED related treatment in next 2 to 3 years or 4 years, then you can opt for a longer waiting period so that your premiums are lower. Okay, if you think that yes, there is a chance you have a good family, history of having this thing, so there are policies in which you can add-ons. There are additional add-ons in which they will waive off this waiting period, and you can start availing the benefit immediately. But the drawback being that the premium will be higher. So look for a shorter waiting period. It's always beneficial. You will find waiting periods to be standard as 2 to 3 years. Now, from a provider perspective, when a patient walks to you with a corporate health insurance policy, it doesn't matter because in corporate health insurance policies, most of the cases PED is waived off. However, when you go to retail health insurance policy, the patient tells you that this is my own health insurance policy, not by my employer. And you are going to treat conditions like cataract, which is a major this thing. And you look at diabetic retinopathy, anti-VEGF injections. You're going for a retinal laser for a vascular occlusion. So glaucoma. These all conditions come under the ambit of pre-existing conditions. So unless and until the patient has completed his the waiting time for the policy, till that time, his claims are not going to be entertained for these conditions. So ensure that if you're handling a retail policy of a patient in your own hospital, the patient should have completed that waiting period, and the patient should be told very explicitly that if the waiting period is not over, then the responsibility of the cover will not be there. The insurance company is going to deny it. Okay. Now coming to network hospital and cashless facility. Understand that the spending money outrightly is going to be a financial burden. Just like in the previous presentation, the entire question about liquidity. So if you see, given an option that whether you want to spend money from your pocket and then file for claim, or you don't spend money from your pocket at all. So anybody would prefer the second option where it is cashless. So as far as in metro cities, network is not a problem because you will find the network hospitals. But if you're in a tier 2, tier 3 cities, it's always beneficial to check for network hospitals. Now, there are few insurance companies who has got a better network in North India. There are few insurance companies like Sriram or Chola, which has got a better network in South India. So this is a very good benchmark that you can go for. But this is relevant only if you look at tier 2, tier 3 cities. But in terms of a metro city, this rarely becomes a hurdle nowadays. And the TAT, now turnaround time for most of the insurance companies is so fast nowadays. And according to IRDA regulations, should be less than 1 hour. And I think a 1 hour approval is a decent enough time. And, ensure that their approvals are prompt. Other than that, that it should not be a benchmark to decide on the purchase decision. But as a provider, as a network hospital, when you're running a hospital, then being in the network of the insurer becomes very important. Because, I have a few doctors who tell me ki I never get an inquiry from any insurance patient asking for insurance. So why should I take cashless facility? The interesting part is the insured patient has already checked on his mobile app whether your hospital is in network or not. So the patient has not visited you at all just because you are not in network. So you don't know which patients you have lost. So let's being in cashless network or not may become a benchmark in the competition in the marketplace where you have to survive. So it's very essential in today's world to be in the cashless network of insurance companies. Otherwise, it's difficult to run a hospital in today's world, especially in metro cities. And same thing is percolating down to tier 2 and tier 3 cities nowadays, where everybody is having an insurance and they want to get the treatment in a cashless network. Coming to room rent limits and sublimits. Now, room rent limits is is a condition that is seen in a lot of insurance policies and sublimits. Now, understand that you are paying a premium and you want a service, right? You want a service where your health will be taken care by them, by insurance companies, and they will ensure the medical bills are paid when you need it. Now, the dictum that you pay what you get what you pay for is very true in insurance also. So if you buy a policy which has got a lower premium, then you will realize that there will be a room rent capping. That is, a particular amount will be limited, that your room rent cannot exceed more than this. Now, in a lot of multi-specialty hospital, what happens is your treatment cost is linked to the room rent. A person from a general ward will pay 1 lakh for the surgery, and for the exact same surgery, a patient from the deluxe ward will end up paying 2 lakhs. Now, insurance companies, what they want is they want lesser expenses. They want lesser bill to be paid for the patient. So what they do is, if the insurance policy specifies only a specific room type, and you opt for a higher room, it is not only the room rent that increases, the expense for the surgery or the treatment also increases. That insurance company is aware. So what they do is they will proportionally deduct it. So if you have a room rent capping, that will restrict your choices of hospital, that will restrict your bills. You might think that, okay, 5,000 room rent is my limit. I'll go for the 10,000 room, but there's only 5,000 rupees per for a night. So maybe for 2-3 days, that extra 15,000-20,000 I'll put from the pocket. But you should realize that the moment you change the room rent, the entire treatment cost is linked to the room rent, and all those treatment costs also will be claimable according to that percentage only. So understand that if you're going for a policy, if you want to buy a policy, please look at the room rent cap. And if you don't have any room rent limits, that would be excellent. Okay. But however, the room rent capping is of 1% of the sum assured is very commonly found. So be aware that what you need. So you cannot buy a insurance policy in which room rent capping is 5,000 rupees, and you cannot expect them to pay for a treatment in a room rent capping of room rent value of 10,000 rupees. Next is sublimit. So understand that we can, as a cataract surgeons, we can operate a cataract, with a basic hydrophilic monofocal, or we can go for a panoptic BBT or a trifocal. So there is a huge range. Now, if you leave it open-ended, the patient will always want to go for the highest benefit that they have. Now, the patient has paid a certain premium, and insurance company has a calculation that how much would be the premium, the claims outgo. So what they do is they will restrict the payment limit for a lot of conditions like cataract, hernia, angioplasty, even anti-VEGF injections are also capped that way, so that the patient does not claim it again and again and again and again, and the insurance company doesn't go into losses. So this is linked to the cataract sublimit, or the other sublimits are generally linked to the policy and the premium. If the sum assured is very high, the limits would be higher. If the premium is, you can get rid of the sublimits if you pay a higher premium. If you want to have a lower premium, sublimits is going to be there. So you should be, see, I'm not saying that sublimits should not be there. The benefit is that with the sublimits, the premium is going to be lower. Without the sublimits, the premium is going to be higher. So you should be the one who should decide whether you are ready to pay that additional premium for getting the sublimit off. Now, as a hospital, when you look at sublimits, we would be interested in basically two sublimits. One is cataract and anti-VEGF. I think other than that, there is no other condition in ophthalmology in which there is a sublimit. So in cataract, we need to know the sublimit because we should be able to counsel the patient, talk to the patient very easily, how much insurance will pay, so that we know where to pitch the patient, what to guide the patient to. So in terms of cataract surgeries, the best way to find out the limit for cataract is ask the patient to call the customer care and directly, outrightly ask bluntly on the phone that what is my sublimit for cataract per eye. So once you get to know the cataract limit, it will be very easy for your counselor to handle the case from there. Now coming to the anti-VEGF, anti-VEGF is slightly tricky. Now, interestingly, anti-VEGF injections does not have a sublimiter of its own. But however, in insurance policy wordings, you will see that there is a specific sublimit for latest technology treatments, in which there is robotic surgery, stereotactic surgeries, radio ablations, all the new technologies. And anti-VEGF injections, intravitreal anti-VEGF injections are also categorized into the same subhead. Now, for that subhead, there is a limit, which may be 10 to 15% of a insurance the sum assured. So, if a person has got a 10 lakh worth of policy and has got a 15% of advanced technology treatment limit, so his entitlement from the insurance company for anti-VEGF would be maximum of 1.5 lakhs. Okay. Now, in that, if he requires monthly injections for 3 months in both eyes, then he will exceed his limit very easily. So this also is something that you can find out from the customer care, and as a provider, that becomes very important. Now, coming to the daycare and OPD coverage. So once upon a time, there used to be a condition that uh, the insurance will cover only for admitted cases where the admission has been done. So that's the reason a lot of people, even now, our patients come and ask that whether coverage for eye is there or not. But over a period of time, with the rules being changed at amendment and improvements, daycare surgeries are being covered as a routine in insurance policies. However, OPD coverage is not common. OPD coverage can be purchased separately as an add-on. But as doctors, do you actually need an OPD coverage? Because most of the times we have our friends and colleagues, it tends to work up very easily. But OPD coverage is not something that we would, I would suggest, because the moment you take an OPD coverage, your premium is going to increase. So whatever add-on, it's something like it's like a supermarket. So whatever add-on you add, it's going to add a premium. So you should be looking at what makes your life easier. Okay. Now, there is something called no claim bonus. So what is no claim bonus? So if you don't make a claim in your insurance, if you are claim free for the year, the next year, your sum assured is going to increase. Okay. So if you buy now there is a different companies who have different kind of techniques in which they do this calculation. So if you buy a 10 lakh worth of policy for a particular premium and you don't claim anything, next year what happens is uh, if there is a no claim bonus of doubling of the sum assured or adding on the sum assured, so your sum assured will increase. So sum assured will become from 10, for the next year it will be 15, next year it will be 20, 25, 30. So few policies, yes, there is a restriction on it, that how much it can be. It cannot exceed more than 200% of the initial sum assured. In some cases, there is unlimited. So these entire now here also the catch being the premium. If you have a policy which does not offer any no claim bonus, then your premium is going to be lower. If you are going to go for a no claim bonus, then the premium is going to be higher. Recently, ICICI Lombard has launched a policy plan in which there is unlimited no claim bonus. Now, you should think that is it actually required? Because you buy a 20 lakhs policy, in 5 years, you are going to exceed a crore. So do you actually need that feature? So that's something that you need to think about. It's something like the sunroof on our car. In Indian scenario, we rarely use it. So do you actually need it is the question that you need to ask. Now, now coming to the co-payment and deductibles. Co-payment is a fixed percentage that you pay for every bill that you claim, that you put a claim. Now, it can be co-payment is something that I would suggest for ease of having a health insurance policy, you should always pick a policy with no co-payment, because that ensures that the entire bill is settled by the insurance company and there is nothing payable by you at the hospital. However, in senior citizens, in cases where the premium tend to be very high, you may be able to reduce the premium. You may be able to reduce the premium by opting for a co-payment. Now, here the decision to take that is totally personal. Yes, it's zero co-payment is always preferred, but you should look at how much difference it is coming in the premium. At a younger age group person, a person with 30 years, 35 years, up to 40, this kind of a issue does not arise because the premiums are lower, the escalation in the premium is lower. But the moment you crossed into the age group of 55, 60, then yes, if you're going for a policy, then you will have to take a co-payment. Otherwise, your premium is going to be exorbitantly high. Now, what is a deductible? Now, deductible is the fixed amount before insurance kicks in. So, you have to spend a certain amount from your pocket, then the insurance policy will cover you. So, if you have a deductible of 50,000 and your bill is 2 lakhs, the insurance company will deduct that 50,000 and pay you balance 1.5 lakhs only. If your bill is 25,000 and your deductible is 50,000, that bill is not eligible to be claimed from that insurance. So this is deductible is very important in terms of super top-up policies. So you have a base sum assured policy for 10 lakhs and you take a super top-up with a deductible of 10 lakhs. Why? Is because that 10 lakhs, which you have taken as a deductible in the super top-up, is going to be covered by the initial policy. So this is the deductible. Now, avoid co-payment and deductible unless premiums are unaffordable. That's what the thing about you should give a calculation and you should, you can go to any of the website like Ditto or Policy Bazaar and just keep on toggling with the options and you will be able to see how much the premium is changing. Okay. Now coming to the same claim settlement ratio and process. So understand that claim settlement ratio is never 100%. Okay. Because there is always going to be some conflict because this is a business transaction. Okay. Now, there are some insurance companies whose claim settlement ratios even more than 100%. Be clear that those are not the companies who are going to stay in the market for long. They're going to be bankrupt. They might sell off. So never depend on them. Now, claim settlement ratio more than 90% is good. 95% is excellent. Understand that when you look at claim settlement ratio of different insurance companies on the internet, be sure to look at health specific claim settlement ratio because there are insurance companies who publish their claim settlement ratios in both ways, health only and combined. So when you compare that, you should be very clear that you are looking at the specific thing. Now, interestingly, what happens is I have observed is the claim settlement ratio is very volatile. This year, Star Health might have a fantastic claim settlement ratio. Next year, SDFC might have. So claim settlement ratio, or more or less, all of them maintain more than 90%. So a decent enough company should be maintained. Now, claim process is online, paperless, and with TPA like Medi Assist, you can just click photograph of your bill, upload on the app, and that's it. So a company with those kind of features, whereas if you look at companies like Sriram or Chola, you have to fill the physical form and send. So this is a matter of convenience. That will add on, that will also affect your choices. Now, maternity and newborn cover is something like a PED. Okay, a person cannot get a maternity cover in the initial year because that will be hiding of material facts. So often we'll have a 2 to 4 years wait. You should look at what are the inclusions, what are the exclusions, newborn cover, whether it is covered or not. So depending on, I have seen people who have bought health insurance at the age of 35 who has completed their family and they have paid extra premium for taking maternity and newborn cover because their agent slowly slid into the options. So you should be aware what you're buying. You should be aware of the terms and conditions. You should be aware of your insurance policy, what it offers, what it doesn't, and you should be aware what premium you're paying for it. Now, another thing is that the no insurance policy is bad as long as you understand the terms and conditions of the policy and you are okay with it. So when you take an insurance policy, yes, there is nothing wrong in taking an insurance policy with co-payment. There's nothing wrong in taking an insurance policy with room rent limit. But you should be aware that this is the kind of policy that you have bought and this is the kind of service you are going to get. So coming to exclusions fine print, this is which I'm repeating the same thing. Whatever you have bought, whichever policy you have bought, you should be very clear that you are aware of the exclusions. You should understand that what are the other nuances, what are the limits, sublimits. You should be aware. And another thing is that you should be very the duration of maintaining the policy is very important. Now, in the field of health insurance, I get few patients as well as doctors who say, "Yeah, I have paid 5 or 10 years of premiums. I have not claimed till now. I am in loss." So remember, health insurance is not an investment. Health insurance is a money that you spend. If you have not used it, forget about it. It is something like that, Triamcinolone and vitrectomy cutter we keep in cataract surgeon's OT. It will be there. Let it remain there. Let it expire. Let us throw it. God forbid you have to use it. So this is the same thing that I tell about insurance policies. You buy it, that premium, forget about it, that money is gone. Don't look at it as an investment that मैंने use नहीं किया. Recently I told one patient, हाँ use करते हैं ना सर, आपको शाम तक heart attack मंगा देता हूँ. So that is the point. So understand that you should have an adequate sum insured. Your PD should not be very high. Cashless network should be reasonable and sublimit transparent claim process. See, understand that every terms and conditions you should look at. Now, one small tip, IRDA has specified that there should be a standard basic health insurance policy issued by every insurer, which is called as Arogya Sanjeevani Health Policy. Every insurance company will have this product, but they will never advertise this product because this is a product which has got zero frills. It's something like हमारा वो होता ना कि go to lens, one single monofocal. In case of any doubt, put it. So this Arogya Sanjeevani policy, you can Google it. You will find the details. You can buy it from any insurer. You will find the premium is the lowest, but there will be a lot of riders. Go through the terms and conditions, take a decision. So that ends my with this short time. I think it's pretty much difficult to cover everything, but I think yes, that's it.
Thank you. Thank you, Dr. Harikrishnan. It was a very nice presentation. Very nicely covered everything. Just a couple of questions, not from the patient's perspective, but from surgeon's perspective. Like, if I'm there in the clinic, sitting in the clinic, and so from your presentation, I could figure out that we should know the sublimit of the policy, and that is the amount that you will get if you are doing a cashless surgery for a cataract surgery, right?
So,
okay. So how exactly will we know that what is the sublimit?
so there are few ways to it. First, if it's a retail policy where the patient has bought the policy himself, his agent will be aware how much is the sublimit for cataract. Or you can look at the card. If the card says Star Health Red Carpet Assure policy, just Google that on Google. Just Google it. You will get the prospectus in which there will be a table which says this much sum assured, this much limit, this much sum assured, this much limit.
Okay.
This is way 2. The third method is that ask the patient to call the customer care from the registered mobile number and ask directly to the customer care executive that what is my cataract disease sublimit. Fourth method, if the patient is a corporate employee with a corporate insurance card, ask that patient to speak to his HR department who's handling the insurance and ask them what is the sublimit for cataract. These 4 methods is all of them has to be is the way to find out.
Dr. Harikrishnan, recently I have a problem. I operated cataract case. 30,000 was sanctioned by the company. I operated case, patient went home. Next day, to my surprise, they have said that only 10,000 patient will get. So how can it happen?
So this can happen in various reasons. Firstly, it is unlikely to happen because of the policy limits. It is more likely to happen if the patient opted for a higher package, you had a cashless agreement of certain amount, but the patient wanted a higher amount, higher implant, and the patient has paid extra, and the patient goes and reports to the insurance company. The insurance company is going to say that, okay, the hospital has overcharged you, we will refund you that amount and we'll capture that amount from the hospital.
No, actually, they sanctioned the 30,000 rupees in the
Sir,
evening.
see, understand
I
that.
operated.
See, depending on what is your agreed rate.
That was 30,000.
No, your agreed tariff rate with the insurance company.
With the 30,000, and they agreed for it in the evening. I operated, and the next day they showed only 10,000.
So if there is something like that, you can, if you can send me the documents, we can have a look. If it's a genuine issue where they have underpaid, there is a way in which GIC, General Insurance Council, has started a grievance center in which you can file these kind of cases, issues, and you'll be able to get a response.
That is happening all over India. All over India, many friends are having same problem. They first they declare that this amount is, then they give the lesser amount.
Sir,
Many doctors, many examples I can give you, and more than 100.
So
and
does it mean
out of that, in 90% of cases, I can point out where the hospital has made the mistake.
Hospital
okay?
has
So one thing
Yes,
I
can
want to
confidently
ask.
say that after seeing so many bills of hospitals.
So that means that the capping, suppose of cataract, depends on two things. One is the patient's policy, which will have a limit, capping limit, and the second would be the MOU of the hospital where he's getting operated, isn't it?
Yes and no. Okay, come to that. Now, if a hospital has got a tariff agreement with the insurance company saying that cataract surgery, excluding the lens, cost 30,000.
Okay.
There, if I put a panoptics, 30 plus 85. If I put a supraphobe, 30 plus 10. If I put a Alcon IQ, 30 plus 13,000. Okay.
But generally the MOU says 30,000 plus IUL not exceeding 7,000.
Ma'am, so that's what I'm coming to. So it depends on the structure in which your tariff is agreed. In my hospital tariff, that 7,000 number is missing.
Okay.
So that is how you have to look at the agreement that you have signed with them and generate the bills accordingly. Now, you say not exceeding 7,000. So what idea is that you put it as cataract surgery, including lens cost up to 7,000, 30,000. Cost of upgradation to lens more than the cost of 7,000. And if you have a lens with a MRP of supraphobe 10,000, 7,000 is included in the first item. And second item, you can put as 3,000 is the additional amount. Total amount 33,000.
Dr. Harikishan, very surprisingly, I also showed to patients. They have written in my agreement, lens of your choice. Mean I can put 30,000, lens of your choice. Mean I can put any Indian lens of 300 rupees. I tell the patient, this is your policy. They have written lens of doctor choice. So do you want the choice of this lens, my lens? So this is very surprising. They are giving 30,000, but choice of doctor lens.
Sir, my question is, why in the world did you sign that agreement?
We don't do. We follow the others. Because we are
No, sir, if you signed an agreement, you have to honor it. That is the point.
That don't do. But how can we get the best agreement? Can you provide us what the next time we should bargain with them the best agreement?
Sir, you understand the bargaining chips, you understand the situation. It's possible. It's possible. There are a lot of hospitals which are doing, like, I'm a newbie. I've been practicing for last 6 years.
Harikishan, sorry to interrupt, but I think we are going off.
We are going
on a little bit of a tangent.
This discussion
So let's close this, and we still have a couple of other speakers.
Yeah.
Let's move on, Rajesh.
Okay. Yeah. Okay. It's really it's a very interesting and topic which everybody wants to discuss, and many people have different varied experiences. So definitely we would love to have a discussion on this in some other webinar, maybe at the end. Let's have Dr.
Your
Sharad
audio
Babu,
is
who will
giving a
be.
lot of sound. Kuresh, mute yourself.
So now we will have Dr. Sharad Babu, who is the Honorary General Secretary of FBS AIOS, and we would like to know from him that why this scheme is good for the AIOS members and why one should join FBS AIOS.
So good evening all. I'll just sum up the things and all. See, all this insurance, what all we have heard now, everything is summed up into safety, liquidity, and the scaling up of everything. So we have this scheme, the Family Benefit Scheme of All India Ophthalmological Society, which we started in 2004, and it's now 21 years old. And if you see the safety part, first part, let us come to the safety part. It is very safe because the whole society is being managed by a group of senior ophthalmologists who have a passion to work for free. Nobody is being paid anything, any amount from the family benefit scheme. And there are no hidden charges in this scheme. So it is very safe. And now you say how safe it is means from last 2004, in the last 21 years, a candidate who joined in 2004, they have paid 1.44 lakhs up to now for the insurance, for their insurance, and the coverage is 25 lakhs rupees up to now. And now coming to the liquidity part, we have two exit schemes. Like somebody wants money for their personal medical expenses or something, they can opt, they can come out of the scheme. After 12 years is one, and after 20 years is the second one. Say if they are a member for 12 years, they have an option to come out, and then 4 lakh rupees will be given. And for 21, after 20 years, if they are a member, almost 7.5 lakhs will be given. So 1.45 lakhs paid for all these 20 years with the coverage of 25 lakhs. Now they want to come out, we are giving 7.5 lakhs. That is almost a good interest, because they are not paying at one time this 1.44 lakhs. They are laddering up for their insurance from the last 21 years. And so they are getting a huge amount of 7.5 lakhs. That is this scheme we don't have anywhere in any of the health schemes or any of these life insurance schemes with any other company. Only the FBS is offering this type of scheme. Now there is another thing. One is as you are telling, the safety part. Now, when you are paying the amount, it is automatically reflected in your website, in your account. You can open up and then see the date when you paid the last 21 years, the date of payment is there and how much is paid, and everything is written there in your account in the website, which is being updated immediately. So it is very safe. You can see your account and then update things and all. Third one is very important thing is the modifying system in this scheme. Now there is this executive members who keeps on talking about, who can keep on thinking about the new schemes, how we can do the feedback system from the members whenever they are giving their inputs. So we go to the actuary, find out if there is something else we can do, something else we can add up. And then we keep on adding these top-ups. As what we are talking about, the top-ups, we can keep on adding up the basic thing, we do that. So new schemes are also, we keep on adding them up. As last you see, we have cut down the admission fee in the last 3-4 years, and then it has come down to minimum amount, and that is what we are doing for the members of that. And the beauty of the scheme is, say the young members, if there are many members joining, what happens is the rate of death also comes down. So what they pay to the thing also, to the member also, it comes down. See, this is again, you have an additional advantage of the income tax benefit. The reason is we are working on a mutuality concept. So the amount what we are paying goes into the expenses, and what we are getting is completely a insurance, the income tax free amount. So this is a very good insurance, the life insurance. Don't compare this with the accidental insurance. Accidental insurance is what other companies, they prefer to give, but our insurance is, it is there for our members and we pay for our members. So one person, one senior member or anybody who dies, a younger member also dies of any disease or accident, no questions asked. We pay them immediately once we receive the death certificate and the death claim with all the documents needed. And we are there for you to assist you in that. Our office is there who can help you in that. And once we receive them and the process is done, no questions asked, immediately we pay the amount. This is how we are working out with the FBS AIOS. And the joining is very simple. You have to go to the website. You can go even to the AIOS website, click the FBS, and then go to that and then apply and then do that. And people, the youngsters who are less than 40 years, we don't need just affidavit. We don't need all these medical things and all, medical checkups and all. Just one small affidavit you can give from yourself that you are free from other diseases and all. We believe you and then we take it. So these are all the benefits. So I request all the youngsters, and because the age limit is only 49 years, which you can join, I request all of you to think about it and then see that not only you, and even your wife, if she is also an ophthalmologist, We request both of you to join this scheme. Thank you very much.
Thank you, Dr. Sharad Babu. Any comment from anyone? Maniar sir?
Rajesh, can you just
Sir.
spell out the website?
The website is
www.fbsaios.in. So that's as simple as that.
Yeah.
Yeah, Rajesh, as both Dr. Patel and Dr. Harikrishna has enlightened us a lot, especially Dr. Harikrishnan has taken out the finer nuances of what to look for in a health claim policy, not from a doctor's point of view, but even as a client with the insurance company, what even our members should look for. And maybe Satanshu and Sharat, etc., Kuresh, we could look for some common terms that we could negotiate with the different insurance policies, companies for our members. See, if we are going to be able to give them a a client base of over 5,000 members, Dr. Harikrishnan, don't you think we can get a lot of benefits for our members in this kind of a way?
Sir, one other issue here is that healthcare providers are classified as you're talking about a group policy for doctors.
No, I'm talking of giving them 5,000 individual members.
Sir, yes, that is possible, which I think AIO is already doing with CoverU. Our treasurer and secretary is involved in that. So with CoverU, there is a individual policy option which is there through CoverU along with AIOS. So that's available in the AIOS website that you can explore, sir.
Okay, thank you. So really nice. I mean, it's been really informative. And as Sharad Babu has said, all those youngsters who are at least less than 49, don't waste time. Just join FBS right away. Go to the website, join right away, because there are only advantages. There are no downsides here at all. No downsides at all. We've been part of it from the inception, and we can tell you with a clean heart, open heart, that there are no downsides here. Join FBS right away. Thank you.
So thank you, sir. Thank you. I would like to thank all the speakers. And before that, I would just like to say that it's FBS is the only term insurance wherein you can get money even during your lifetime. You can exit the scheme after 20 years or 12 years, and you can still get in your lifetime if you need it at old age, if you need it for your health reasons or whatever reasons. So it is a twin kind of a policy, and that is its uniqueness. And of course, we had three wonderful speakers today, Dr. Akash Patel, Dr. Harikrishnan, and Dr. Sharad Babu. Dr. Poonam Jain, excellent way of handling a presentation and moderating it. That was wonderful. And I would like to thank each one of you and all the panelists and all the members who joined in to be a part of this webinar, an informative webinar. And I will request the speakers that in future also we would require your help in telling our members, informing our members about various kinds of financial policies and schemes. So thank you very much, and a very good night to all of you.
Thank you, Dr. Rajesh.